So Chapter 11 deals with standard costs. That's going to be most of it. And then at the end of the chapter, it'll introduce you to something called a balanced scorecard. Okay. I think basically speaking, in this case, we're going to be doing the first two objectives today. Okay. So learning objective 1 helps us to understand and distinguish the difference between standards and budgets. Okay. So basically, budgets are about a total amount, whereas standards really are about a unit amount. So, McDonald's knows and has standards for how much they're going to be paying for hamburger and pickles and buns and things like that. They also have standards for, how long a burger is going to be cooking on the grill and needs to be flipped and so forth. All those are standards. Each of them can actually be boiled down to an amount, as you'll see. And these standards help us understand why budgets are sometimes off. And oftentimes it really kind of comes down to what's happening. So you're going to find this out in more detail today. So looking at standard costs have specific advantages, specifically for management planning. It helps employees understand the costs that are involved in various things. It, of course, helps us to understand what we should be selling items for. It's very, very important in cost controls to understand that. And of course, what we're going to be doing later is looking at the differences, what we call a variance between the standard cost and what actually happened. And then, of course, we can look at things in other parts of the business like inventory and other specific costs and simplify how those are looked at. Setting standards basically is common across all industries. There are standard costs in all industries. They all kind of have their own benchmarks to some degree. But within an organization, all persons who are involved and have responsibilities for costs and quantities are going to be involved in helping to set a standard. Okay. Existing standards are only there and are the same unless something changes. And if something changes, then we know that we're going to have to update that measure of performance, that the existing standard costs should change when certain things change. And you'll see that play out very soon. So normally speaking, we have ideal standards. So under optimum levels of performance and perfect operating conditions, these are what the ideal standards are. But of course, as you know, optimum levels of performance don't happen very often. Perfect operating conditions don't happen very often. So we will then settle for what we call normal standards. And so normal standards are, in essence, what are efficient levels? These are the efficient levels. This is where we want to be at. It may not be ideal, but it's close enough to be very, very efficient. Okay. So these are the standards that are often applied that you'll see coming up in our examples. Okay. So when it's done well, when it's done right, these standards are not just rigorous, because again, they're promoting efficiency, if not optimal levels and perfect conditions. But they're reasonable enough to be attainable, means that people can do it, the organization can do it. And so these are very important for all businesses. Okay. So most companies use standards at a normal level. Okay. Not an ideal level, but a normal level. It's nice when it's higher than that. And like I said, all types of industries have standards. You can go ahead and look at the Open Standards Benchmark Collective or Collaborative, which is a group that includes various companies and organizations like IBM, Procter & Gamble, the US Navy, the World Bank. Right? They all set standards and standard costs. And that's how they become efficient. That's how they measure efficiency. That's how they measure performance. Oh, I'm sorry, I'm having these. It's tree pollen season, and that's exactly what gets me going. So the best way to understand all of this is to review a case study and then to do some things based on that. So this is our focus today, really. So to establish a standard cost of producing any particular product, you have to establish standards for each element, such as direct materials, direct labor, and manufacturing overhead. Okay. So how we do that? Well, the standards for each is derived from a standard price and a standard quantity. Okay. So let's take a look at direct materials. So first, the direct material price standard is the cost per unit that should be incurred. Okay. So for a particular item, we have a purchase price of materials plus freight plus receiving and handling. And so the standard price per pound given in this illustration would be $3 a pound. This becomes the standard in which things will be judged. What the actual is going to be looked upon based on the standard. That's going to be the comparison. Okay. For the actual quantity, the quantity standard is the quantity of materials that should be used per unit of goods. What should we be using to create it? Well, 3.5 pounds is required. There's going to be some allowance for waste and spoilage. As in manufacturing, waste and spoilage happen. Okay. So that means the standard direct material quantity per unit, in this case, is 4 pounds. So now we actually have a standard direct material cost. We have $3 per pound is the standard cost per pound. And we're going to be using a standard of 4 pounds per unit. That's what should be used. And that's what it should cost. So the total standard cost for direct materials is $12 per unit. $12 per unit. Okay. So the question here, the direct materials price standard should include an amount for all except what we call normal spoilage. Depends. Again, some businesses will include a spoilage factor. Okay. So the direct labor, we also call it the direct labor rate standard. It's also called the direct labor price standard, but rate and price, same thing. So that's the rate per hour that should be incurred. Okay, should be incurred for direct labor per in this case per hour. The hourly rate plus the cost of living adjustment plus a payroll tax plus a fringe benefit. The standard direct labor rate per hour based on this $15 per direct labor hour, and how much direct labor hour is required to make 1 unit. That's the direct labor quantity standard. Some books actually have it as the efficiency standard, right? What time should be used or required to make 1 unit? Actual production time, 1.5 hours. Some rest periods, cleanup, setup, bathroom breaks, a little smoky, bathroom break. Direct hours per unit, 2. So for every unit that the product that's made, it should take 2 hours at $15 an hour. And so the standard labor cost is 30 bucks. 2 hours at $15 per hour. That's the standard. For overhead, now in this case, they simply use what's called a standard predetermined overhead rate. Okay. And again, the overhead rate usually is dividing the budgeted overhead costs by whatever the standard activity index is, such as labor hours or machine hours. Okay. So this usually is given to you. And in this case here for overhead, they're going to produce 13,200 gallons of product X, right? That's normal capacity. It takes 2 direct labor hours for each gallon. So that's basically how they're going to be allocating the overhead. Variable overhead at 79,200 divided by 2 hours per gallon. So 13,200 times 2 gives you your 26,400 hours. So that means the overhead rate per hour in variable cost is 3 bucks. In fixed costs is 2 bucks. In total, the standard cost for manufacturing overhead in total, 5 bucks. Okay. So per gallon, it takes 2 hours to produce 1 gallon at $5 per direct labor hour. So we're going to allocate $10 in overhead for every gallon that we produce. So when you look at the total standard costs, knowing about all that, and actually here is the product, it's not product X, it's actually product Zonic Tonic. I wouldn't touch it with a 12-foot straw. Maybe. We're measured by the gallon here. So here are the cost elements that we have standardized. Direct materials, 4 pounds, $3 a pound. Standard cost, 12 bucks. Direct labor, 2 hours, 15 bucks an hour, 30 bucks total. Manufacturing overhead is based on labor, so 2 hours at 5 bucks, 10. So the total standard cost per gallon for materials, labor, and overhead, 52 bucks per gallon. So that's the first thing that we are breaking down. How do we calculate standard costs? And that example, that case study is what you're going to be practicing for the next couple of days. So here we have a company, Ridet Inc. They accumulated the following cost data concerning their product CTY31. No relation to R2D2 or any other strange things there. Here is the material per unit, 1.5 pounds at 4 bucks a pound. Labor per unit is 1/4 of an hour at 13 bucks an hour. Manufacturing overhead, the predetermined rate is 120% of direct labor. So 120% of the amount of labor here. So here we have direct materials, 1.5 pounds at $4. Standard cost for materials, $6. Direct labor, a quarter of an hour, $13 an hour, $3.25. The overhead is 120% of that. Right. So in this case, 325 times 120, 1.20, 120%, 390. So adding all that up, your total cost per unit, $13.15 per unit. That is the standard cost to produce 1 unit of CTY 31. Fascinating. So now that you know how to calculate standard costs, we can actually review standard costs to what actually happened. We call that actual costs. Actually, sounds good. It's a little different from the standard. The difference between actual costs and standard costs are what we call a variance. Okay. And variances are always reported on a regular basis. So when the actual costs are actually less than the standard costs, that's good. So that's a favorable variance because this is what our expected costs were based on efficient levels. If actual costs are below that, we were more efficient. That's favorable. In the case where actual costs are greater than the standard costs, then we didn't meet that level of efficiency. We were below the standard, and so we have an unfavorable variance to report. Okay. Variances are always looked at by what caused it. What was the underlying factor that caused the variance? And it doesn't, whether it's favorable or unfavorable, there are reasons why the variance exists. And thus those variances are analyzed, okay, in detail in many cases. So again, here, a variance is favorable if your actual costs are less than you expected, less than your standard costs. In this case, the standard cost was based on a level of efficiency. You beat that. You were more efficient than you thought. That's favorable, quite favorable. All right, so let's take a look at an illustration that throws this total in an example, and that's going to help you with your homework here. So assume that we are producing 1,000 gallons of Zonic tonic. I wonder, can you drink that on the Taconic? Don't know. You can drink it with friends. It can be platonic Zonic tonic. Okay, I'll stop. So again, we're producing 1,000 gallons of platonic Zonic tonic that you're drinking on a Taconic in the month of June, and you're incurring the following costs: direct materials, direct labor, and your fixed and variable and fixed overhead are listed. Total actual costs were 55 grand. Okay. Your standard costs you calculated at 52,000 gallons at $52. So your variance is 3,000. You spent 3,000 more. Your costs were $3,000 higher than the standard. So this is not good. So this is how we would do all these math functions to look at the variances. So when you check out direct materials and direct materials alone, in order to produce 1,000 gallons of the platonic Zonic tonic, you used 4,200 pounds of direct materials. And these were purchased at a cost, this is an actual cost of $3.10 per unit. But you had a standard price of $3. So what's the variance? Well, the variance is going to be the actual quantity times the actual price minus the standard quantity times the standard price. That's going to be your difference. So you actually spent $13,020 because you had 4,200 pounds of materials at $3.10 a pound, which was higher than the standard quantity, which you should have done it with 4,000 pounds at $3. So thus the variance in this case is simply the difference, $1,020. It's unfavorable because you were above the standard. That means it actually costs more. You were less efficient than the standard. Because remember, that whole standard price, that whole standard quantity is what should have happened, right? That's the shoulds. Excuse me, doctor, I got a bad case of the shoulds. Shoulds. But that's the shoulds. The standard is the should have happened. Right? Actually, was above that, unfavorable. When you look at the materials, you then, again, the next thing is you're going to be analyzing the total variance to determine the amount attributable to cost, price, and what was attributed to quantity. So that means we're going to be looking at this a little bit differently. Actual quantity times actual price, that's going to be the same. But we're going to subtract out the actual quantity minus the standard price to get a price variance on these materials. So again, the first part doesn't change, 4,200 pounds, $3.10 a pound. But since we use 4,200 pounds, what if we kept it at $3, which is our standard price? Well, that still means we're off. Right? We're off by $420. Right? Our actual price, actual quantity is higher by $420. But what about just looking at quantity? Same numbers, but now we're just looking at quantity. We use the same, in order to isolate quantity, we're going to use the same standard price. Okay. So here we have actual quantity times standard price minus the standard quantity to see what happened here. So the actual quantity was 4,200, standard price was 3. So that's 12,600. We had 4,000 as the standard quantity, standard price of 3, 12,000. So as you see here, the $600 unfavorable is really a lot more on the use of the material than the price. I mean, the price certainly was off, but clearly the quantity variance is higher. So we used more materials than the standard. I mean, that's really this is most of the variance is the quantity variance, not so the price variance. 60% of the variance is quantity related. And this is how these things are sort of analyzed. So this is the step-by-step. First thing we do when we analyze, as you see here, analyzing and reporting these variances, we take the actual quantity times the actual price. And then we compare that to the actual quantity at the standard price. And then we're comparing that with the standard quantity at the standard price. Okay. In order to identify the total price variance, we need to look at two things, right? The actual price paid, which is what number 1 tells us, with the standard price based on what we actually use, which is what number 2. So that $420 unfavorable difference reflects on the price of the materials. Okay. When you're looking at the quantity, what's happening with quantity, then we're going to be looking at the actual quantity at the standard price, or what it should cost, and comparing that to the standard quantity at the standard price. So we're comparing 2 and 3, these two boxes here. And you see here, as you know, that's a $600 unfavorable variance, which means because this number is larger than that number, most of this difference is because of quantity issues, using more so than your price certainly is a factor, but the quantity made a bigger difference in this case to this variance. So that's going to be sort of a matrix you'll be using. Again, just to sort of understand these is important. So what can cause variances in materials? Well, for price, factors that affect the price might just be what's available. Were we able to take any cash discounts or not? Because again, if we take a cash discount, that lowers the price of our raw materials, our inventory, right? What about the quality of those materials? Did we use more materials because they were in inferior quality, and so we had to make up by using more of those or not? Or perhaps it was something to do with how they were delivered and the cost regarding that. So again, all of these things are analyzed, and of course, it's the purchasing department that's going to have to be their own little Sherlock Holmes here to find out what caused those variances. Why did we pay so much more? Why did we use so much more in case of quantity, right? So if the variance is due, in terms of quantity, why to use more? Well, could be a number of different reasons. One is you could have workers that are not experienced or not trained well, so they used more material than necessary. Maybe it's the machinery, that's at fault and thus created a need to use more material. Maybe it's just good old fashioned, I don't give a variance about work, and so it might just be total carelessness. So again, that might be something to look after as well. So you are so primed for this. You are so ready to get into this variance type thing. I know it. I can just feel it. So here is do exercise 2. We have the standard cost of Wonder Walkers. I might need one when I get older. They include 2 units of direct materials at $8 per unit. During July, the company buys 22,000 units of direct materials at $7.50 and uses those materials to produce 10,000 units. So we are going to be computing the total, the price, the quantity variances for these materials. So first things first, here we're looking at our standard quality. Well, we are going to be producing 10,000 units, right? It's easier to do in the book than it is on these slides. Okay. So our standard quantity here, again, 2 units of direct materials per, and we have 10,000 units. So the standard quantity, 10,000 units at 2, is where those numbers came from. Okay. So when you go ahead and substitute the amounts, you get the following variances. They actually bought 22,000 units of direct materials. They paid $7.50 for them. Okay, so 22,000 pounds of or units of materials at 750 is what they actually bought. They had, okay, a standard of 20,000 units, that's this, times the $8 per unit. That's the standard. So the actual minus the standard gave them an unfavorable variance of $5,000. Okay. That's for total materials. When you look at the material price variance, you've got 22,000, which is the actual, times the 750, which is what the actual price was. Subtract out the 22,000, which is the actual by the standard price, $8. And there they spent much less on those materials. They had a favorable outcome of 11,000. Okay, because they got a price break, right? They only paid 750, whereas their standard price was 8. That's a big savings. In terms of quantity, they actually bought 22,000 when they originally were going to set a standard of 20. So 22,000 times 8, actual times your standard price, minus 20,000 times 8, right, your standard price. Now, that meant that in this case, the quantity provided them with an unfavorable, right, 16,000 unfavorable. So that's the total right here. There's the price right here. And here's the quantity right here. So these three things are what we did right here. And that's going to be your homework. Okay, that's what we're going to be focused on. I see a lot of variance in your mood right now. Could be standard.